Thanks for joining us today on Market Call. I'm Morella Fernandez. Matt Kacur on the show with us, president of FSA Valuation Service. He'll take your questions on North American Equities. Here's how to reach us. Call us toll free at 1-855-326-6266. You can send an email question in as well. Market Call at BNNBloomberg.ca. Matt, good to see you. Happy New Year.
Thanks for having me, and Happy New Year.
2025, a strong year for the North American market. Do you expect 2026 to be quite as strong?
Well, I think you'd be kind of foolish to expect as good, especially not just this year, but the last 3 years have been spectacular. I have it at 23% year over year, so 3 years in a row, roughly, or on average. The normal long-term rate is closer to 8 or 9%. So to expect 4 years in a row of 20 plus, I think, that's a bit unreasonable.
Yeah. Okay. So let's talk about where we could see some strength this year. Last year, of course, was all about AI, all about tech. Do you continue tech stocks? Do you think tech stocks will continue to be strong and have growth this year?
Yeah, we're not going to back off from our technology stocks for sure. We're still, that's our heaviest weighted sector, and it's the heaviest sector, the largest weighting in the S&P 500. But I think we're a little touch overweight there, and we're not backing off just because it was a good year. We think the fundamentals are strong. The growth is tremendous. I cannot believe sometimes when I look at these projections, and sure, I think some of these projections can get, maybe a bit aggressive, but there is real growth there. There's real earnings. There's real return on capital. This is not some kind of speculative kind of market run. This is just like real good fundamentals right now.
Have you trimmed it all? Have you moved some of the tech money around?
Normal rebalancing, but I wouldn't say beyond that. Like, if we have a, big position, you got to stick with your policy statement. And if you're over, 7 or 8% in one name, you probably trim it a little bit and you can free that up for something else. But, like I said, we're fully invested, maybe slightly over-invested or overweight in technology. Yeah. Okay.
What other sectors do you favor right now?
Yeah, so we're going to stick with materials as well. I think the backdrop there is pretty strong, especially gold and precious metals. I think a lot of people, have some geopolitical risk in their mind right now, and that says go to gold. Gold also is a hedge against inflation. Inflation is still very strong. So I think even if the price of gold doesn't move too much, I look at the stocks themselves and I go, boy, they look really cheap. There's a tremendous cash flow there, return on capital. The valuations don't look too crazy. There's been remarkable restraint and not over mining, overbuilding, and just trying to get every little spot. The cash cost per production has been pretty good, and fundamental or financially, let's say. Revenue growth is there. Margins are still good. So everything looks good there, too.
Okay, let's take a quick break. We'll line up the first phone calls and emails for Matt Kacur, FSA Valuation Service. Again, he's taking your questions on North American Equities. Here's how to reach us. Back in a moment. Welcome back. Matt Kacur with us today as our guest. We're going to start with a question in an email from Ted, who says, what does Matt think of CNQ, which is Canadian Natural Resources? There was an amount of pressure yesterday on the oil stocks with what's going on in Venezuela. A little bit of a bounce back today or an evening off, but not really much action. What do you think about CNQ? Do you think oil is going to continue to drag into the later part of the year, this year?
Yeah, I don't think energy's particularly strong here. We don't have big weighting in it. We have, of course, your standard weighting, but nothing beyond. In fact, we're probably underweight a little bit. There's nothing wrong with CNQ per se. It's probably one of the better ones in Canada. But I'm just not, overly enthusiastic about the whole space. But if I could get a little more specific, and we're mostly a quant shop, so I'll talk about the quant a little bit and the fundamental quant. So we do see improving return on invested capital, and that's a key metric for us. So we love rising return on invested capital, always looking for that metric. And the valuation is pretty reasonable. So in terms of overall Canadian oil and gas, it's let's call it top quartile, but not top 3 or 4.
Okay, that was for Ted. Let's go on to our first caller. Judith is in Barrie, Ontario, with a question. Hi, Judith.
Yes, good afternoon and Happy New Year to you both.
Thank you.
I have a question on the Royal Bank. It seems to be getting quite high priced right now. Do you think in the future it will be splitting so that, more people can invest in it?
Okay, thank you for that question. Matt, I've had this question before. And what's the determination for splitting? What would be taken into consideration for the bank to split?
Well, as you know, splitting it doesn't actually do anything fundamentally to the shares, right? It doesn't make the company bigger. It doesn't. It can make it more accessible and more liquid. $238 though is usually accessible to most people. I mean, you can buy one share nowadays, so that'd be $238. Most people can, do that. I don't think it'll make a much of a difference at that level. I kind of find, right around 1,000 is where people start to go, I don't know if I can, buy even one share, or, you have a model or something and they're calling you for, 5 shares and you can't even do it sometimes. So I don't think that this level it's going to make a difference. Now, a little bit more to her other part of her question was, I think the longer term, I think Royal Bank could be the best bank in the world in terms of investment. I think it's super consistent. It's so well run. It's not even that expensive. So I know we've had a nice run here in the last 2 years or so, but this is a buy and hold and forget about it kind of stock. So it's awesome.
All right, Judith, I hope that helps you out. Let's go to Scott, who has written in an email. It says thoughts on Thomson Reuters after its price drop in the last few months. Matt, Thomson Reuters has a sort of a very niche business now, I guess. What do you think of their business? And when you look down the road for Thomson Reuters, do you think it could or will regain here?
Yeah, well, again, we're a fundamental quant shop, so I'm going to kind of stick with that part of it. And we have always had trouble with this stock, trying to understand it. And now that doesn't mean it's a bad stock necessarily. It just means it just doesn't quite fit when we're trying to model it. And I know there's lots of acquisitions, and then there's spinoffs, and that really kind of messes up, I think, anybody's model. So I think it's still a very good topic to talk about because I love this space. I personally, I'm not going to touch Thomson Reuters just because of that complexity I just discussed of the accounting problems. But I love this space. So I'm going to give you some alternatives. SPGI is the ticker, and that's the S&P Global. That's the name of the stock, but you know it as the company that runs the S&P 500 and all the indices and all those things like that. There's a number of other good options in that space. MSCI is a good one. FactSet. Basically, these data providers for Wall Street, I think they're just such a really good space. It's recurring revenue. It's a high return on capital business, very consistent. And, who produces more data than Wall Street? And it's hard to find industries that have this volume of data. As you know, just stock charts alone are tick, tick, tick every tick of the way. And these kind of data providers are awesome.
I know you don't, you're not looking at Thomson Reuters specifically, but because it's dropped so much, If you were invested, would you consider getting out or would you hang on to the stock? Do you have a sort of rule of thumb for that?
Yeah, I mean, rule of thumb with this, I think you would stick with it. It does have, a good brand. And I think it's a well-run company. But again, I just have so much trouble when I get into the weeds, I go like, I don't quite understand what's going on with the accounting. So for that reason, I have to step out. But for other reasons, like I said, brand recognition, by all means, it's a well-run company. So I don't have an issue from that perspective. I just have alternatives that I think are more interesting.
Okay, let's go to an email then from Howard in Comox, BC. He says, good morning. Does your guest agree that BCE is a good buy at this stage? Interest rates coming down and the company's restructuring well underway. And a reminder, BCE is parent company of this channel under the Bell Media banner. Matt, BCE, what do you think forward looking? It has come down quite a bit. The company is changing the way it does business. What do you see here?
Mm-hmm. I mean, it's a solid idea at this level. There's nothing wrong with it. I personally, let's roll back a little bit. I didn't think they needed to cut the dividend when they did. I know people were calling for it, and it was a big topic amongst dividend holders. But I think they had generated enough cash flow. But they, on an earnings basis, it looked a bit like it was difficult to pay the dividend. But when you kind of add back the non-cash items like depreciation is a big number for them, I felt they could still pay. But having said all that, they have cut the dividend. And what the current yield right now, I have at about 8%. So I don't know if that's 100% right on, but it's going to be somewhere around there at this time, I think. And I think, that is clearly sustainable since the cut. And I do think the fundamentals, I like a good restructuring story as well. Those are very difficult sometimes, but they can be extremely rewarding. So I think you're good with BCE.
Okay, I've got a dividend here of 5.43%.
Okay.
Just for information there. Okay, we're going to take a quick break. We'll be back with Matt in just a moment to answer more of your questions. Here again is how to reach us. Back in a moment. All right, we are going to rejoin Matt Kacur right now. He is our guest today. We're going back to an email from Richard who says, does your guest consider Accenture, ACN, to be a buy currently? What are your thoughts on Accenture, Matt?
Yeah, I like Accenture. I know it's had a little bit of a rough go here. And I think in another segment I was on, I called it like an anti-AI stock, right? I've got all these AI stocks are doing really well, and then you've got some that are just not participating, and you might have thought they would. I think the market sees AI as a threat to Accenture's business, but I think it's kind of overdone. There's also an opportunity for Accenture to do really well in, helping companies deploy this and understand what it means for their business. At the moment, the market is saying, hey, this is a threat, but I think they'll find a way. Fundamentally, the numbers are still very, very good. So I'm going to stick with the current fundamentals and be aware of this threat that the market seems to be pricing in. But overall, for me, that looks like an opportunity.
Why do you think the threat isn't as big of a threat to a company like this one? If you can just give us an idea of what your thinking is.
Well, innovation comes along all the time. And there's always a need for consulting, right? Like, you think you can just press your button and AI is going to tell you everything and you don't need anyone to help you figure it out. Well, go ahead and try that and see how that works out well for you. And, you're obviously they consult at a huge scale. And deploying things at scale, you're going to need experts that know how to do this. And they've always done it for, we're talking, 30-year track record of being able to do this with all the innovation that's come along, from no internet to the internet to, all the other things that have come along. I don't see them all of a sudden just, one new technology comes along and they're wiped out, or well, not wiped out, but not doing as well. I don't see it. I think they'll find a way.
Okay, let's go to the phone line. John is in London, Ontario with a question. Hi, John.
Hi, Marilla. Hello, Matt. Matt, I bought General Electric, did very well when it split into three components. I held it all along. I bought Honeywell just before it spun out its first component. It's got another spin out coming later this year. I'm ahead on the aggregate of the two entities now. What does your quant model say about Honeywell? Thanks very much.
Okay, thank you for the question. Matt.
Yeah, Honeywell's excellent. So I think you're really good there. And then you kind of get the added bonus when they start spinning these things off. Usually that unlocks value, typically. Let's say on a standalone basis, so I just ran it here through our model. Very consistent return on capital, 15% return. In the trailing 4 months, I've got 18% return on capital. I don't think it looks all that expensive. And like I said, typically these restructuring spin-off type stories are positive.
Okay.
So I like them.
John, I hope that works for you. Let's move on to Peter in Toronto with a question. Hi, Peter. Peter, are you there? Okay. It looks like we may have lost Peter on the line. Let's go to an email from Sam. Sam wants your view on heavy oil producer Athabasca. As we mentioned, some of these oil stocks got hit yesterday with the news out of Venezuela and the concern that there will be more Venezuelan oil on the market and that will compete with Canadian oil. Can I get your thoughts first, Matt, on that situation and if that's a concern for you? And then we'll talk about Athabasca specifically.
Yeah, it is a concern for me. I wasn't particularly bullish on energy to begin with. And this kind of just exacerbates it a little bit. I don't think it's as big an effect as some people might think, but it didn't do it any favors, and I was already kind of not loving the sector anyways. So I hope that kind of answers that part of the question. In terms of Athabasca, from a quant perspective, it looks excellent, actually. It is kind of what we're looking for. I see improving return on invested capital. Again, that's almost our number one metric. And, it was in 2020, basically not earning a return on capital at all to earning 10% in the trailing 4 quarters. That's a really nice move. Also, a very clean balance sheet. They haven't over-levered their balance sheet. Yeah, I quite like it.
Okay, that is the word on Athabasca Oil. Let's go to Hank's email. He says, could I have your thoughts on Banco Santander? A lot of questions we've had about some of the banks sort of out of country and financials out of the country. Banco Santander, what do you think?
Yeah, I like that that bank as well. I will not pretend to be an expert on a bank in Portugal and Brazil, I think is where they operate mostly. But I can run our numbers, and I think it's excellent. In fact, I've talked to some clients about this one recently. It's been very consistent for about 10 years now, earning 10 to maybe 15% return on capital. In fact, it's earning the 15% at the moment. So that's kind of the high return on capital, high watermark for the last 10 years, which we love. And you see the stock has reacted to improving fundamentals. But I don't think it's overdone. It looks like, a fairly fair value company that's improving their operations. I'll take that all day long.
Okay. And they are primarily, I guess, in Spain. And they do have a dividend, which is kind of nice. It's only 2%, but at least you are getting paid. So you would put some money in if you were looking in that direction.
In terms of, again, we're fundamental quant. So our fundamental quant model says, hey, this is what we're looking for. Yep.
Got it. Okay, we're going to take another quick break. We will go through Matt's past picks when we come back. Stay tuned for that. Welcome back to Market Call. Let's go through Matt's past picks from August 6th of 2025. Amphenol was your pick at the time, Matt, APH in New York. They do connectors and cables. It was $109.50. US at the time, up to 136.31 at this point. So 24% upside, 25% total return. Can you remind us a little bit more about their business and why you're optimistic about it?
Yeah, so I think you kind of touched on it there. Connectors, infrastructure, electronic, sensors and equipment to connect, like the internet, what's another, electricity, those sorts of things. And it's all about the connection and moving data, not just data, but electricity and other things along any type of pipe. So that's kind of what they do. In terms of their fundamentals, the quants, this has been a really good one for us for many, many years. In fact, I think we've owned this for over 10 years. And it is kind of one that we buy and hold. And fortunately, the last couple of years have been extra good, including, I guess, since August. But it's one that I would hold for the long term. I'm just checking out our profile here, and we're now at 41% return on invested capital. For an industrial company, that's really difficult to do. Now, it's not always that high. It's generally around the high 20s, but very consistently in the high 20s, and pretty good valuation. Now, it does say 29 times EBITDA, which is a bit high in general, but given the quality, I'm okay with it.
Okay, and you said you've held it for about 10 years. Have you trimmed with that run-up it had over the last year?
I'd have to really look to see if we trimmed it or not, but we certainly do follow our policy statement. If it goes over a certain amount, we would definitely trim it. I don't recall that we've actually had to do that.
Okay.
So I don't think it went over our threshold.
Got it. Okay, let's get to your next past pick. CBOE Global Markets on the NASDAQ at the time, 248.10 US, up to 250.95. So 1% in return, 2% in total return. And they do sort of exchange holding companies, so platform solutions. Is that sort of the main part of the business for them?
Yeah, so we kind of touched on this when someone called in about Thomson Reuters. This would fit in this category too. They're actually an exchange, an option exchange. That's their biggest revenue generator. I think 60% of their revenue comes from option trading on their exchange and listing fees, those sorts of things. But they also do provide data, which is, as I said earlier, I love this space. I think it's an amazing space. The return on capital on this company is over 50% very consistently. I find it's not expensive. It's a nice trader that it kind of just moves up and to the right with not too much volatility. So yeah, we're definitely not changing our mind on that. Another thing I'd like to add is I think they have a very clean balance sheet. So yeah, this would be one of those in that space that we talked about earlier.
Just wondering if people are looking at something like this to get into. As you mentioned, not a lot of volatility, but it does go sideways, drop a little bit here and there. Would you wait to pick it up if you were picking it up as a new investor? It's at 249.39 is where I have it now.
No, I wouldn't. I mean, look, dollar cost averaging for any stock that you're getting into is probably a good idea, but this just isn't volatile enough to sit around and wait. So, buy a tranche and then build your position like you would with anything, but there's no reason to sit around and wait too much longer.
Okay. Let's get to your last past pick was Microsoft, very well-known stock. 524.94 US at the time you recommended it last summer. Now to 470.97, so 10% drop return, a total return drop of 10%. Have you held on to Microsoft? Have you put any more money into it? And what is your thesis for Microsoft in the year ahead?
Yeah, so this has been a long-term buy and hold. I think we said, Amphenol with 10 years? I think we've had this one for 20. So, not the least bit worried about a 10% pullback. I would be adding here for sure. I don't know how much more of a good business. I think it's the number one recurring revenue business in the world. I don't think it's expensive. it's such a big company that certainly it trades kind of with the market. It has like probably a beta of like 1, so it's going to be kind of a market trader. But I think in the long run, it probably actually beats the market. I'll take quality over exciting any day, and this is just as high a quality as I think you can get. Again, clean balance sheet, not even expensive. Return on capital is improving. It's up to 24% at the moment. Great products. I mean, it's just the top software name, in my opinion.
Okay, good to know. Let's take a quick break. Lining up more phone calls from Matt Kacur of FSA Valuation Service. Again, he's taking your questions on North American Equities. We're back in a moment. Welcome back, and thanks for joining us. Let's go to Paul on the line. He's got a question today for Matt. Hi, Paul.
Yes, energy fuel, silver.
What about it?
Does he agree that the factor between silver and gold historically was at 25, and right now it's at 56, and it's off where it should be, and how does he see it compared to gold, and how does he see it for the future coming?
Okay, thank you for the question, Paul. So basically, the future of silver, we know it had some catching up to do with gold last year, which it did. Do you still like silver for 2026, Matt?
It's a kind of hard question for me to answer exactly. I know the ratio between gold and silver is supposedly, I think it was 30 supposed to be. But I don't do a ton of work on commodities, so we just focus on the equities. Now, I do have an equity that I like that's in silver, and that would be Fortuna. We've owned that one for about a year and a half now. We see, the fundamentals improving there. We see return on capital improving to 16%, which is pretty high for a commodity, and probably higher than most gold companies as well. Now, there's certainly more gold companies to choose from. I'd like to have a few more ideas in silver. This is the one that we've kind of been using as our silver idea. I'd probably do a little bit more homework on some other silver ideas, because I do think overall silver is probably a good place to be in a portfolio along with some of your golds.
Okay, that was for Paul. Let's go to Colin. He is in New Brunswick and has a question. Hi, Colin.
Terry.
I'm sorry?
I'm Terry.
I had trouble with that as well.
So did I. Colin, what's your question?
I was wondering about Northern Power.
Northland
Oh,
Power.
Northern
Okay.
Power.
Northland Power is what we're getting here. What are your thoughts on Northland Power, Matt?
Yeah, so there was a recent stock drop, and I kind of remind myself exactly what that was for. I think it was after earnings, and there were some delays announced there.
I think it was, project delays. You're right.
Okay. So I do think that's probably an opportunity, though, just based on, our model says it's actually a pretty good company. It's quite consistent. It is sort of a utility, but it's, renewable energy. So it's a little bit more volatile than a normal utility. But I still think the fundamentals are good. As long as they get this, keep a close eye on this project. I think it's appropriately priced. I think it's actually pretty cheap, given, the pullback has made it cheap, and there was a good reason for it. But I think it's probably an opportunity.
Okay, so you dip in at this point.
Yeah.
Okay, let's go to Andy in Calgary with a question. Hi, Andy.
Hello to the both of you. And thank you very much for taking my question. Matt, I would like to know your thoughts about the potash commodity and the industry as a whole going forward here? Do you think it's a buy? And what are your thoughts about Mosaic? I know it's priced a little bit cheaper, maybe in comparison to Nutrien. I'm just going to hang up and listen to what you have to say about that. Thank you very much.
Okay, thank you for the question. Let's talk about potash. Let's talk about Mosaic. What do you think of potash? It sort of bounced around a little bit. I know it had a slower start to last year and then came back and now sort of trailed back down towards the end of 2025. But this is Mosaic specifically now at 25.03. What do you think?
Yeah, I kind of like Mosaic. Again, I'm not an expert in the commodity that it trades. You know, it's nutrients, potash, excuse me. And you know, I don't really know where the price of potash is going. I know it's volatile. I do know that. So you got to be careful in that regard that you got a volatile underlying commodity that they deal with, right? Now, having said all that, the last couple of quarters for Mosaic have been really good. And that's very encouraging to me. And if you can kind of catch these cyclicals on an upswing that we're seeing in the last 2 quarters, after kind of an abysmal, 6 quarters in a row here that we're showing, I kind of like that idea as a bottom kind of turnaround. I will say that's kind of higher risk, though.
A higher risk because?
Because of the commodity, uncertainty in the commodity.
Generally speaking. Okay. That was Mosaic for Andy. Let's move on then to Jim. Jim's in Pickering, Ontario with a question. Hi, Jim.
Hi, good afternoon. Thank you for taking my call. My question is on Enbridge. I think it's reacting a bit to certain recent geopolitical events or event. So I'm wondering if it's a good time to buy Canadian and add to a position in Enbridge for the yield and for longer term. Thank you.
Thank you for the question. Enbridge at 62, almost $63 today. The high was September, I guess, of last year at 70.21. Would you dip in at Enbridge at the $63 range?
Yeah, I would. We own some of this. I'm not sure of how much we own of it, but a decent position, I would suspect. And I know it's it's a high quality. It's kind of one we don't have to overanalyze this one. It's one that we just kind of hold in our portfolio because we know it's a good company, and we ride out the kind of the ups and downs. And I wouldn't let this action in Venezuela change my mind on that. It's quality. Yes, you should be buying Canadian right now. I've been kind of bullish on Canada since the beginning of last year. I kind of like that we've been given a wake up call that we got to open up our country for business. And I think we're at least starting to do that a little bit more and more. And Enbridge would definitely benefit from that. So I would, given that it's come back a little bit, I would definitely step in here.
Okay, that was for Jim. Let's take a quick break. We will be back with Matt Kacur in just a moment. Stay tuned. Welcome back. We have Matt Kacur with us today. He's taking your questions. We're going to go to an email from Don. He's in Belleville, Ontario. He says, what happened to P&G? What is your long-term outlook for this company? Do you have a long-term outlook for P&G, Matt?
Yeah, just give me a moment here. I'll try and we're going to run it here, but I kind of know the story. This is a high-quality consumer products company. It certainly goes through a few cycles here and there. It's been going through a cycle in terms of the market. Okay, I like to separate the market cycle from the actual operations cycle of the company. I think the operational cycle of the company is actually pretty good. A lot of these companies have had trouble with inflation, but I just don't kind of see that with a little bit, I guess, with Procter & Gamble. The revenue growth has been kind of low, and it's certainly, it's picking up a little bit. It's 3% in the last quarter, which is not huge, obviously. But operationally, in terms of their bottom line, they've actually kept margins pretty strong. And I haven't seen that with a lot of these consumer product type companies. Their margins have been getting worse. But it's certainly about as cheap as I think I've ever seen it in 20 years or so. So you got high quality, you got low growth, you got pretty solid margins. There's probably a decent dividend on this one.
It looks like a 3% dividend, but I'm wondering if you'd even tap into the space right now. How do you feel about the consumer moving forward?
Well, I'm not all that bullish on the consumer. I do think they're having trouble, but this is more consumer defensive, right? This isn't a luxury item. This is, toothpaste and soaps and things like that you pretty much have to buy no matter what. So I would step in here. I think Procter & Gamble's a pretty good idea. Now, don't expect a huge return. Expect your dividend. Expect 5 to 10% appreciation for a year. So maybe you get 8 to 10% total, 8 to 13% total for the year, kind of thing. I think that's a reasonable expectation.
Okay, so dig in if at the level and maybe hold for a while. Let's go to the phone lines again. Gord's on the line. He's in Kingston, Ontario. Hi, Gord.
Hi, I'm interested in TELUS. Do you have any thoughts about that? Thank you.
Okay, thank you for the question. We didn't talk more broadly about telecommunications. TELUS, of course, made a change to its policy regarding its dividend without cutting its dividend. First of all, what does the business future look like for TELUS? And did that decision they made, that announcement they made, sort of affect how you look at it down the road?
It's not that much different than Bell, right? It's kind of half a dozen one way, 6 another. I could almost repeat what I said for Bell that I would say for TELUS. It's okay. It's not amazing. You're probably going to get your dividend. I think you're okay there. Growth is low. Let me check the growth, give you a better number. The last 3 quarters, 3%, 2.7, and then 0.5% growth. So you're looking at a low growth kind of company, and you're looking at getting your dividend and hopefully a little bit of price appreciation. So I wouldn't get overly excited. I tend to tell people in this space, I think Rogers is a little bit better. And then the one I really go for is usually Quebecor.
Okay, and why is that?
It just seems to have a better profile for us. It has a better return on capital. I think some of their media assets seem to prop it up a little bit more.
Okay, let's move on then to an email from Stu. May I please have Matt's opinion on Rio Tinto as a long-term hold? Let's take a look at Rio Tinto. We'll pull that chart up in a moment. What are your thoughts on Rio Tinto?
Yeah, I like the question. Long-term hold, I think, you can do it that way. It is definitely cyclical, which means the stock is going to be cyclical as well. But in the long run, yeah, you can kind of just hold Rio Tinto. But you can also, this is kind of a different one that you can actually get in and out of just because of the cycles of commodities. And if you're following the commodities closely enough, you can kind of play it that way. But having said all that, at the moment, I would definitely be in the stock. We see, improving return. We see commodity prices going higher. I think they continue to go higher. So you got this high quality miner, very diversified, by the way, in lots of different commodities. So gold, silver, aluminum, copper, lots of different commodities. Especially in this part of the cycle, I would hold it. I would hold it for long term, but I also think you can kind of trade in and out of this one because of the cyclicality of
the tariff on aluminum. Obviously doesn't bother you. You mentioned how diversified the company is.
Well, it's also diversified geographically too. So it would be hard to unwind how all of these tariffs would actually, fall out in terms of, their percentage of the company. Frankly, I don't know the answer, but I don't think it's all going to the U.S., which is where the tariff would be. So, I don't think you should let the tariff change your mind on this.
Got it. Okay, let's take a quick break. We'll have a look at new picks from Matt when we come back. Stay tuned for that. Join us tomorrow on Market Call. Jamie Murray will be with us on the show. He's president of Murray Wealth Group. He'll take your questions on North American Equities. That's tomorrow. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time now for new top picks from Matt Kacur. We're going to begin with Broadcom, AVGO, on the NASDAQ. What do you like about Broadcom in this techie space?
Okay. It's a phenomenal company. And I think there's really four kind of horsemen of the semiconductors. And Broadcom would definitely be one of them. The others would be NVIDIA, ASML, and Taiwan Semi. I mean, if you have, I think you should own all four of those. They're the top dogs, in my opinion, in kind of in different parts of the, I don't know, the supply chain, how things are done, whatever you want to call it. And where Broadcom fits in is the movement of data, right? So NVIDIA is the kind of the brains, the logic, the mathematics, how things work that way. And then you got to move that data as fast as you can, at lightning speed, at the speed of light, so to speak. And Broadcom is the one that does that. And it's like the network. So top-notch company in that regard. It is the top company in that space. In terms of the financials, which we love, is our quant model. The revenue growth for the last 4 quarters has averaged, well over 20. Let me see if I can just get the quick average here. I have it at 24% for the last 4 quarters. It was even actually a little bit higher than that. But of course, it's getting bigger and bigger, so you can't keep growing at those high rates. But its growth is still tremendous. The return on capital is 41%, which for, again, a big company like this with big infrastructure too. It's not a... they have factories and you're getting a 41% return on capital. It's unbelievable. I don't know what else I can say. The fundamentals are great. Oh, I know one more thing I can say. After the last quarter, it did kind of have a bit of a pullback. I guess investors were expecting even more, but I think it actually said it beat the posted expectations, but somehow some investors expected even more, and there's a pullback. So to me, it's an opportunity.
Okay, that's Broadcom. But let's get to your next pick, Lululemon, which I guess you're perhaps thinking there's going to be a bit of a comeback, but it's a much more competitive space than it used to be. Why are you looking at Lululemon?
Well, one thing, everything you said is correct, but one thing is, the price, right? Like we're talking a massive pullback here in the last 2 years. I think this touched $500 2 years ago. And we're talking 215. It's actually come off a bottom too. I think it got as low as about 180, somewhere around there. And fundamentally, it actually hasn't been maybe as bad as the stock price would have you believe. You'd think that it was completely falling apart. Actually, revenue's been growing. Now slower than before. The last 3 quarters was 7% and 6.5%, and then 7 back to 7 again. So somewhere around 6-7%, which is not huge, but again, the stock is less than half of what it used to be. And margins have tightened. Okay, so let's be clear. It's rarely do you get a stock that is growing and maintaining or increasing margins, and it's down, as much as that. You have to have some reason why it's down and why it becomes an opportunity. So, yeah.
And a new executive in office for that company as well, right? So we could see. Yeah, we could see some change down the road for Lululemon. Let's get to your third pick. Is it AIMTech on the New York Stock Exchange? They do, and we talked a little bit about the space, electronic instruments or sort of behind the scenes to make things work. But what do you like about this company?
Yeah, exactly. So I love this space, okay? I think, building of the grid, you could think of it that way, and that's all tied into the data center, and energy needs are just going higher and higher. And they're about building that kind of infrastructure and the equipment that you need to do that. So financially, again, our model is we have 10% growth in the latest quarter. We have a tremendous track record of return on invested capital, super consistent, and actually rising in the last, say, 5 years. Valuation-wise, we got it slightly undervalued in our model on a multiple basis, 22 times, which is a bit high, I guess. That's EBITDA. That's our preferred multiple. But, you know, if you look at the stock price, it's basically up and to the right. It just keeps marching. You know, it's my kind of company, high quality, block and tackle, high return on capital.
Okay, that's AIMTech AME on the New York Stock Exchange. Matt Kacur, we thank you very much for joining us today. Good to see you.
Thanks for having me.
And we'll just have a quick look at the markets before we take another break, because we do have a new intraday high for the TSX. We had a high close yesterday, and today it's at 32,298. So up another 80 points today, a quarter of 1%, and up 28%, almost 29% so far on this in the 1 year. A couple of oil stocks we're going to take a quick look at. They were battered yesterday by the Venezuelan news. A bit of a comeback for Suncor today. It's up under 1.5%, excuse me, 89 cents. Canadian Natural Resources still down, and Cenovus Energy also still down today. That does it for the close. Thanks very much for joining us. We'll see you back here tomorrow.